Most people talk about earning more money. However, not many people talk about how to effectively manage it. While creating wealth is essential, it is equally important to protect your funds and use them prudently. Your hard-earned money needs to be saved, invested, and spent judiciously in a systematic manner in order to ensure long-term stability and liquidity. This can be done through effective money management. There's no magic formula for building wealth and getting rich. It's simple, really. Spend less than you earn and save as much money as you possibly can. But in a world filled with student loan debt, cost of living increases, growing inflation, and sudden financial emergencies, executing this straightforward plan might sound like a fairy tale. We are exploring some ways to manage your money wisely. For becoming wealthy, you need to start investing early. This gives you more time to grow your wealth and get back higher returns in the longer run. You get high returns because of the magic of compound interest. By investing early, your money has more time to compound and generate additional returns on your initial investment. You also get longer investment horizon. You can afford to take more risks and invest in assets with higher potential returns, such as stocks or equity-based funds, because you have more time to recover from any short-term losses. Warren Buffett started investing at a young age. He bought his first stock at the age of 11 and filed his first tax return at 13. Buffett's early start in investing allowed him to benefit from the power of compounding over many decades, ultimately making him one of the wealthiest individuals in the world. As a rule of thumb, you should always save first and spend later. First, save some part of your monthly income, and then start spending your money on regular essentials like groceries, rent, electricity, loan repayments, insurance premiums, etc. This ensures that you are prepared for a future contingency and eliminates the chances of overspending or exceeding your budget. By prioritizing spending over saving, you may compromise your financial security in the long term. Saving first allows you to allocate funds towards your financial goals, such as buying a house, starting a business, or saving for retirement. By consistently saving a portion of your income, you make progress towards achieving these goals over time. Having savings provides peace of mind and reduces financial stress and anxiety. Knowing that you have funds set aside for emergencies or future expenses can alleviate worries about unexpected financial setbacks. Saving first gives you more flexibility and freedom in your financial decisions. Now let's talk about why many people can't build wealth. The major reason is debt. Not all debt is bad, but high-interest debt is downright terrible if your goal is to get rich. Part of your budget must involve a plan to crush your bad debt and maintain responsible levels of good debt, like a mortgage. The debt avalanche method is one of the most popular ways to rapidly reduce interest costs and pay down high-interest debt quickly. With this strategy, you'll put the maximum toward your highest interest rate debt and make the minimum payments on other debts. While you might be tempted to accelerate paying off lower interest rate debt like student loans or your mortgage, think again. You'll save more in the long run by paying off your higher interest rate debt first. Only then crushing that house payment and any lingering student loans. Being dependent on credit cards or taking on too much debt can hamper your budget and become a financial burden. So try to limit your debt as much as possible. On the path of wealth creation, actually, it's not about managing and keeping it in your saving account. It's about how you are investing money. As per data, many people keep their money into saving account because of lack of financial knowledge, and they are not ready to take risk due to fear. You should learn about different investment options such as stocks, bonds, mutual funds, real estate, and retirement accounts. Diversify your investments to spread risk and maximize returns. By diversifying your portfolio, you can reduce the impact of market volatility and minimize the risk of losing money. A well-diversified portfolio typically includes a mix of stocks, bonds, real estate, and other asset classes. Stay informed about market trends, economic developments, and regulatory changes that may impact your investments. By diversifying your investments and planning for the long term, you can mitigate financial risks and create a stable financial foundation for the future. Investing in assets that have the potential to outpace inflation can help preserve the purchasing power of your money over time. Wealthy individuals often refrain from making impulsive purchases and instead focus on making thoughtful and intentional spending decisions. Practice discipline and restraint when it comes to spending money. Think critically before making significant purchases and consider whether they align with your financial objectives. Live modestly and prioritize financial sustainability over conspicuous consumption. Prioritize financial planning and establish clear objectives for wealth accumulation, retirement planning, estate planning, and risk management. Most important thing to do while managing money is regularly review and adjust your financial plans as your circumstances and goals evolve. Embrace a mindset of lifelong learning, innovation, and adaptation to navigate changing economic conditions and achieve sustained wealth creation. On this note, we bid farewell to these discussions. I hope you find value in this video. Kindly share it with someone you care about and wish to inspire on their journey towards financial success. Subscribe to us for more financial knowledge. The more you know, the better decisions you'll make. From the bottom of our hearts, thank you for joining us today. See you in the next video. Until then, take care.